All right, guys. Welcome! First of all, happy 24th, 12th, whatever. Welcome to my second explanation video. Today we are going to look into liquidity and liquidity sweeps by Summerson, aka the Big Funded Max OG. And if you take notes, if you keep listening, this is going to be you at the end of the video. So keep taking notes. Maybe Maybe there's a quiz at the end. Quick little overview. I separated in two different sections. So first of all, I am going to explain what liquidity is and how we find it. And once we know what liquidity is, I'm going to explain to you what a liquidity sweep is and how we can use it with a pretty good example and a quiz at the end of the day, at that presentation. So what is liquidity? I'm going to keep it short. Liquidity are basically just resting orders above highs or below lows. Liquidity is the fuel behind the market. Market makers need contradicting orders to enter or exit their positions. Keep that in mind. Market makers need contradicting orders to enter or exit their positions. So in order, if you have an apple right here, okay? You can't sell this apple if there isn't another person who is willing to buy that apple from you for a certain price, right? So if you have a person who is going to sell, you have to have another person who is going to buy. Otherwise, there's no interaction in between those, okay? Basically, liquidity are resting orders. How can we find liquidity? Liquidity is all over the place, all over the market. It lays above highs and below lows, as I said. What is a high? What is a low though? I'm gonna explain to you real quick. A high is a move up and a move down. So over here, there's liquidity. A low is a move down and then a move up. So down there, there's liquidity too. So every swing high, swing low, every high or low you see, there's liquidity resting above or below that, okay? So imagine an uptrend right here, tach, 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 tach. Liquidity there. Downtrend, tach, 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 tach. Liquidity right here, right here, right here. Liquidity right here, right here, and right here. Okay? Look at the chart, find significant, in the best case, significant swing high and swing lows. Mark out the range. The most significant swing high is your buy side liquidity. The most significant swing low is your sell side liquidity. Mark those two out, and you have your liquidity point, liquidity, whatever the say word is I'm going to look for. So, and what is a liquidity sweep? A liquidity sweep is a reversal conference. It's not a continuation conference. We do not use liquidity sweeps for continuation. We only use them mostly on a higher time frame to understand where market is going to go and when market is going to reverse. Right? And basically a liquidity sweep is a push. So imagine this is the high, okay? A liquidity sweep is a push above a high with the intention to fill orders, to fill their orders in order to move the market, in this case probably down. So yes, as we know, this is the high. What do we have over here? Liquidity. What are liquidity? What is liquidity? Resting orders, buy orders, sell orders, whatever it is. Resting orders. So we come above this high, fill all the orders, contradicting orders, mostly buy orders above here. So in order to fill all of our sell orders, we have to have people who buy. So we push above this high, hold other buy orders right here. In order to fill the sell orders, we have to like take them out and we can dump, right? That's how the market makers basically move the market. And how can we use it? Um, we use it to understand where price might draw to. So higher time frame, equal lows, I don't know, session highs, session lows. Liquidity can be used to get a kind of an idea of where price wants to go to, understand when price wants to reverse. So it's most likely to reverse after, I don't know, 4 hour equal highs get taken out and you see a lower time frame break of structure to the downside. Then just write I don't know, um, like if there's no reason to reverse, we probably ain't gonna reverse. And third, to set your stop loss or your take profit. Liquidity can also be used as that. And since I told you I have an explanation, so I am trying to make this very clear, okay? So let me grab this pen. These motherfuckers are retail traders. This motherfucker is a retail trader. And let's say this here is the market maker, right? Okay. So imagine this, okay? Imagine this scenario. This is the market maker, okay? He sees all of the retail traders right here, okay? Above this high is a whole lot of cash. This person sees this person, and there's a whole lot of cash. So he thinks, alright, I'm trying to hit a lick on this guy, okay? So he starts running. He starts running towards him. He starts shooting though. Pull out his Glock 22, okay? Start shooting. Pach, pach, pach. What is he trying to do? Okay, get out of the line. So, zack. Retracement. He's trying to dodge the bullet, okay? Retracement, dodge. So he keeps pushing. Tach, tach, tach. Dodge the bullet. Retracement, tach. Once he's right near him, okay? Out of bullets, so what does he do? He swings at him, trying to punch him. Bam! What is the market maker now? The person here trying to do? Retracement, alright? To get out, to not get hit. The retracement to fill something in here, probably a value gap, alright? So these two motherfuckers think, oh no, he trying to escape, okay? He trying to escape. Those are the bodyguards of this person, okay? The bodyguards, oh, he's trying to escape. He's trying to run down, okay? Trying to catch this move down. They trying to catch his move down. But oh no, he fuck with y'all, okay? He's just trying to not get hit with the weapon. He trying with the weapon, okay? So he takes a step back. They think, fuck, he's going to escape. So they run down here, okay? They are gone now. They are gone. They ran down here in an trading thing. These are the people who thought this retracement right here is going to be the move um, to take out all of this liquidity. So they thought they're going to sell and have their stop loss right here where the money is at, okay? But so yes, market makers here. So dodge that, think, ah, fuck you, I'ma take your money. Bam, bitch, takes all of his money. So since he has no money, he pulls out his fucking big ass bazooka, trying to light that shit up and bam, shoots right at him, okay? Because he thinks, oh, he's trying to escape, he has my money, he's going to run away, okay? He's going to run away. Retail mindset, retail trader mindset. Why? Because he now has the money, he don't need anything up here. Why would he continue? He has the money. He wants to go down here where the money is at, right? The money is right here now. So he catches all of this money, sees the bazooka, booming at him. So he says, no, fuck you. He dodges that, runs down, bam, dump the market, takes off all this liquidity. Boom, fuck you, retail trader. I make my money, you don't. That's basically um, my example for the day. I hope you kind of get an idea. So what I was trying to say, those are the retail. This person is the retail trader who thinks we keep creating higher highs and higher lows. We must be going up, okay? So he keeps on buying. And those are the people who think, oh, on this move, oh, this is the reversal. I am going to sell with my stop loss above here. Since they have to sell, they have and market keeps pushing up, they have to buy back their orders at a higher price, 1 euro, 2 euro, right? So they have to buy back their orders at a higher price. So very much buy orders resting above here, okay? In order to sell though, we have to have a person who is going to buy, as I said. So market pushes up, takes out all of these buy orders, takes off all of these orders right here, in order to fill their orders, to fill their positions, since they want to sell, since there's a whole lot of liquidity down here. They want to sell, fill off this buy order, so it's like a trade fit. So this, you know what I'm saying? And then they can dump the market where they want to go. Take off this liquidity. Once they took out this liquidity, alright. So now I want to go back up. Boom. You know what I'm saying? Okay, that's it. So quick quiz. A quick quiz for the end. Liquidity sweep are used for continuation. That is absolutely fucking wrong. Wrong. They are used for reversals. Market only moves towards liquidity. Only moves towards liquidity. Okay, I don't think I spoke about it. So you can know market moves to seek liquidity or to balance out an imbalance. We covered that yesterday. Imbalance is a fair value gap. Market only moves to balance out an imbalance, the retracement, or to seek liquidity. So market only, the only is important here, moves towards liquidity. No, also moves towards balancing out the thing. And do you see the clown that hides from gaze? Well, I see him frequently. I saw him right here yesterday. I see him frequently. So I see him. I don't know about you though. I don't know about you though. Think about it. So this was my presentation for liquidity sweeps. I hope you guys liked it. Um, I can give you, let me just give you a real life example. 4 hours since a person commented it would be good. Okay, what do we see here? Bam, we have liquidity right here, okay? Liquidity right here, what are we doing? Bam, we come up, sweep this liquidity. We swept this little tiny, but we did though, and we dump, okay? We dump, fuck. So what are we seeing here? Bam, liquidity, whole lot of orders resting down here. What are we doing? Bam, we came down, fill their orders, and bam, we dump. It keeps on happening, okay? It keeps on happening. Woo! Probably going to sweep this and dump. That's it. Peace out.